I'm here in Washington, D.C. for work all week long. I had meetings planned for pretty much all of today, and then it started snowing. And it snowed about 4 inches and the whole city just shuts down. So I'm here in my hotel room just working on things. If I was back home in Idaho, 4 inches of snow was nothing. I don't know why people are freaking out. Here, come take a look at this. Yeah, there's like 4 inches of snow on the ground, so I don't know why people are freaking out. Because I'm in Washington, D.C. for the week, I tried to think of something kind of clever that I could incorporate personal finance and Washington, D.C. together and come up with something cool. Just about the only thing I could think of was the IRS, which I don't have to tell you, there's really nothing sexy about the IRS. What makes real estate really unique is all the tax benefits that are associated with it that you really just don't get with any other investment. Cash flow is probably the biggest factor that you want to take into account when you're looking at buying an investment property. In fact, I wouldn't recommend buying an investment property that doesn't cash flow at all, and I know that I personally wouldn't. But that's not the only factor that you want to take into account with real estate. What makes real estate really unique is that you can make money every single month, show a loss on paper, and have almost no money that you have to pay to Uncle Sam come tax season. Now, before I get into this, I just want to throw out there that I'm not a CPA, I'm not a tax lawyer, so make sure that you check with somebody who's a professional that can go over your taxes with you, because each and every person's individual situation is so different. So, tax deduction number 1 is the mortgage interest. This is probably the biggest reason why I'm such a big advocate on not having properties that are paid off. When you pay off your investment property, you don't have this massive tax deduction. With an investment property as well as your primary residence, all of the interest that you pay towards your mortgage is tax deductible. So tax deduction number 2 is your property taxes. So just like your mortgage interest, everything that you pay to the county in property taxes is 100% tax deductible. Now this is different for primary residence. So if you have a $250,000 mortgage, then only the first $10,000 of your property taxes can be written off. With an investment property, 100% of all the property taxes that you pay for the year are tax deductible against your rental income. Tax deduction number 3, and probably the biggest one of all, is depreciation. So the IRS lets you depreciate your property over the course of 27.5 years. But that's only the property itself and not the land. So let's say you have a property that's worth $100,000. Just for easy numbers, we're gonna say $20,000 of that is land and the other $80,000 is the house that sits on it. So you can take that $80,000, divide it over 27.5 years, and each year that comes out to $2,900 that you can depreciate on your taxes. The really interesting thing about this though is that properties don't really depreciate, they appreciate. So while your property is going up in value, the IRS lets you depreciate it, saying that it is going down in value. Now this really helps out because things will break. I mean, over the life of a property, you know, you're gonna have to remodel a bathroom, or the flooring is gonna have to be replaced. Now, the downside with depreciation is that eventually you're gonna have to pay taxes on that. the IRS still wants their money whether it's now or later, and they're going to recoup it at some point. So you may be saying, okay, well, I would rather pay taxes on it right now versus later, and so I'm just not going to depreciate my property. You can't do that. When you go and sell the property, the IRS is still going to have assumed that you depreciated the value of that property, whether you did or not. So it's best to take the depreciation now. Now, there is a way to avoid paying taxes on that depreciation entirely. That's one of the great things about real estate, is there are so many tax benefits. This brings us to tax deduction number 4, which is the 1031 exchange. This is one of the biggest tax deductions that almost every real estate investor uses, and if you're not using it, you should be. A 1031 exchange allows you to sell the property and then roll that money into another property of similar or greater value. This allows you to defer the taxes almost indefinitely. If you keep rolling that money into more and more properties and never sell them, you never have to pay taxes. This is how so many people acquire millions of dollars worth of real estate and never pay taxes on it. Now, let me give an example here. Let's say you start buying real estate in your 30s and you keep, rolling these properties into another until you're 60 years old. And then you say, you know what, I'm ready to retire. Let me just sell all of my properties. All of those taxes that you've just deferred for over 30 years, eventually you're going to have to pay. If you sell after 30 years, you have to pay taxes on all of that depreciation, everything that you've deferred, and that's going to be a pretty hefty tax bill. When I was 1 year old, my parents built a brand new house. They lived in that until I was in 7th grade, and then they moved into a different house that was just a little bit bigger, and just with all these kids, they just needed a little bit more space. So they kept their first house as a rental property, and we just lived in our second house until I, moved out and went to college. 4 or 5 years ago, my parents sold that first rental property, and I think they got $235,000 for it. Because they had bought that first house nearly 20 years prior, it had appreciated so much in value that the capital gains on that sale were $50,000. You should have seen my dad when the accountant told them that they had to come up with $50,000 out of their pocket to pay for those taxes. I think at the time, had I had a little bit better track record with real estate, at the time I was just starting out, I think I could have convinced my dad to do a 1031 exchange and so that he didn't have to pay that $50,000 in taxes. The fifth and last benefit that we're going to talk about is the fact that real estate is not considered self-employment income. Most of us work a W-2 job, meaning that you go to a place to work and they give you a paycheck. If you're self-employed, the government still wants a part of that money that your employer is already paying. So let's say you start a business from home and it becomes wildly successful. The IRS, they're going to get their money one way or another. You now have to pay taxes for yourself, but you also have to pay the self-employment tax, which your employer is used to paying. That self-employment tax comes out to 15.3%, which you have to pay in addition to your marginal tax bracket. You can be working 100% full-time as a real estate investor and not have to pay that 15.3% self-employment tax. Now, before I wrap things up, I just want to re-emphasize that I am not a tax lawyer. I'm not a CPA. So you really want to check with somebody who knows more about this in your specific situation so that they can really explain and walk you through the process. The other thing that I want to emphasize is that a lot of these are specific to buy and hold investors. So somebody who purchases a rental property with the intent of putting tenants in it. If you're a real estate investor and you work more on flips, not all of these are going to apply to you. This is just meant to be an entry-level video on how to get started with real estate taxes and really just to demonstrate why real estate is such a good investment as opposed to some of the other things out there that you can do. As always, I hope you enjoyed this video. Thanks so much for watching. Be sure to hit that like button, and if you're not already subscribed, please do so. Next week we'll be coming out with another video, and we'll see you then.